let me review the topic. You know that there are different types of earnings per share. You know that there are different types of earnings per share, don't write. One type of earnings per share is what we call the basic earnings per share. That one is what you should know. And number two, we also have what we call diluted earnings per share, diluted earnings per share. So those are the two earnings per share that normally the examiner would require you calculate. So I want to remind you how to calculate them. Now, to compute what we call the basic earnings per share, we normally take what we call the earnings that are attributable to the ordinary shareholders. Whatever are the earnings that are attributable to the ordinary shareholders, then you divide that by the number of shares. That is what will give you the earnings per share. And of course you know, because we are revising, of course you know, to get the earnings that are attributable to the ordinary shareholders, we normally take what is called the profit after tax of the company and you less preference dividend. You minus the preference dividend, that which you get once you take the profit after tax. Listen, that profit after tax is what normally belongs to the shareholders. So if your company has some preference shareholders, you remove their dividend. They are entitled to their dividend. Once you take the profit after tax and you minus the dividend that belongs to the preference, then that which remains is what we call the earnings attributable to the ordinary shareholders. That's all about the numerator. Then we normally divide that by what we call the weighted average number of ordinary shares. We divide that by the weighted average number of ordinary shares. That's how we normally get what we call the basic earnings per share. You take the earnings that are attributable to the ordinary shareholders. Once you get the earnings attributable to the ordinary shareholders, you divide that by the weighted average number of shares. Now, the most difficult thing in this calculation is normally how to compute the denominator, what we call the weighted average number of shares. And I want to talk about what can affect the number of shares in a company. What can affect the number of shares in a company? So allow me to take you through the different reasons or different things that may change or may cause a change in the number of shares. Okay, so now you know the formula of getting the earnings per share. I've told you the numerator is not a big problem. Normally the problem comes with the denominator. Good. So I want to assume, listen to this now, I want to assume that as a company, you began your year with 2 million ordinary shares. Then during the year, some transactions took place during the year which affects the number of shares. And because they issued the shares during the year, that being that it will affect the number of shares, then we have to calculate what we call the weighted average number of shares. So let me assume that maybe on 1st of July this year, your company had the following things that took place on 1st of July. One, don't write. One, suppose your company issued on 1st of July, your company issued maybe 1 million ordinary shares at, let's say 1 million ordinary shares at full market price. At full market price. Meaning you issued 1 million shares of 10 each at a market price of 20 and the company and the shareholders paid you 20. How do you compute the weighted average number of shares? That one I'll remind you in a short while. Number two, that is number one. Number two, another thing that can affect the number of shares is when, for example, during the year, assuming on 1st of July, your company issued another 1 million shares at full market price, but they are partly paid. They are partly paid at the end of the year. How do you use them to compute what we call the weighted average number of shares? There are different rules. Those are the rules we shall emphasize in this topic. Those are the rules we shall emphasize in this topic because this topic how to compute the weighted average number of shares. That is the key thing in the topic of earnings per share. It is that you must remember the rules of each and every item that took place during the year. That's the second thing. I'll talk about it in a short while. Another thing that may take place during the year and affects the number of shares is that what if again your company issued another 1 million shares, but this time as bonus shares? How do you use them to compute the weighted average number of shares? Your company issued 1 million shares on 1st of July and they were issued as bonus. Of course, you know bonus shares are those shares which are issued to the existing shareholders free of charge. They are those shares which are issued to the existing shareholders free of charge. So how do you use them to compute the weighted average number of shares? What's the rule for them? Good. We shall talk about them. The next transaction that can take place during the year is what if again during the year your company issued, maybe on 1st July again, your company issued another 1 million shares, but this time as a result of a stock option. As a result of a stock option. You know, don't have to ask you, you know what's a stock option? Stock options occur when your company gives a privilege to the employees, when your company gives them a privilege to buy shares at a price below the market price. Let us assume the company issued 1 million shares. The market price of these shares was 20 shillings, but your company gave your employees the privilege to buy them at 15 shillings each. And they bought 1 million shares on 1st of July. How do you compute the weighted average number of shares? What are the rules? That's what we shall talk about in a short while. Number 5, another thing that could have taken place during the year and affects the number of shares is what if again shares of 1 million, I'm assuming 1 million for purpose of illustration, assuming another 1 million shares were issued on 1st of July as a result of a rights issue. As a result of a rights issue. How do you use them to compute the weighted average number of shares? You all know what is a rights issue. A rights issue occurs when the company gives the existing shareholders the privilege to buy extra shares at a price below the market price. Maybe the market price per share is 20, but you as a company, you give a privilege to your existing shareholders to buy more shares, maybe at a price of 15. How do you use that 1 million shares to compute the weighted average number of shares? Those are rules we shall talk about, which I'll remind you in a short while. Another thing that could have taken place during the year and which could affect the number of shares is what if your company issued some shares as a result of what we call a share split? As a result of what we call a share split. Your company did a share split on 1st of July, maybe in the ratio of 2 for every 1 or in the ratio of 5 for every 1, whatever the ratio the examiner will give you, but your company did a split of shares on 1st of July and maybe they issued 1 million shares. How do you use them to compute the weighted average number of shares? There are rules for the share split. We shall discuss them in a short while. Another thing that could have taken place during the year is what if on 1st of July your company issued another 1 million shares as a result of conversion of debentures or preference shares of debentures or preference shares. In other words, listen, in other words, many years ago, your company had issued what we call convertible debentures. So those debenture holders of yours decided that from July this year, they want to convert their debentures into ordinary shares. And they converted. Once they converted, you as a company, you issued them 1 million shares on conversion of their debentures. How do you use them to compute the weighted average number of shares? What are the rules? That's another thing we shall ask ourselves. What about preference shares? Many years ago, your company issued convertible preference shares during many years ago. Come 1st July this year, those preference shareholders decided that they are going to convert their preference shares into ordinary shares. How do you use them to compute the weighted average number of shares? Good. That's another thing we shall discuss. What are the rules? Number 8, another thing that could have taken place during the year and which can affect the number of shares is when your company issued maybe another 1 million shares as a payment of the purchase consideration, as a payment of the purchase consideration, in acquisition of a business, You know this, for example, when you are buying a company, you are supposed to pay them whatever is what we call the purchase consideration. Now, when you paid that purchase consideration in terms of shares, you don't buy the company by paying them in cash, but you decided, you as a company, let's assume you are a holding company, you decided to buy a subsidiary and you issued them with 1 million ordinary shares. You issued the subsidiary with 1 million ordinary shares as a payment of the purchase consideration in that acquisition of a business. How do you use them to compute what we are calling weighted average number of shares? Good. So these are things that you should remember whenever you have a question testing you on earnings per share. You all know, because we are revising, sometimes the examiner would bring a question where 3 or 4 of them took place in the same year. Mostly you find 2 or 3, no, maybe 3 or 4 items being brought. But to some extent, some questions will bring up to 5. They may not bring all the 8 in the same question, but you are told during the year the company issued shares at full market price. Then maybe on 1st of August, they issued some 1 million shares as bonus. Maybe on 1st of September, they issued shares as a result of a rights issue. Maybe on 1st October, they issued some shares on conversion of the preference into ordinary, and so on. So some questions may give you 3 or 4 transactions that took place in the same year concerning the number of shares. Let me take you through again. For each of these. And this is where I want you to understand. Once you have understood the rules, then I have no problem when I'll be doing the question. Sawa. So we start. I have said at full market price. If you want to put down the summary, I'll be giving the summary Q form. The key thing. I'm not going to do an illustration of how to calculate the earnings per share, blah, 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 when shares are issued at full market price. No. I'm only giving you the key summary points. So that when I'll be doing a question and I come across one of the items, then you will remember the key. I'm not going to do an illustration now. No. I'm only going to give you the key important rule for each of those items. Good. So number 1, when shares are issued at full market price, what is the rule? For example, we began the year with 2 million shares, and on 1st of July, your company issued 1 million shares. Company issued 1 million shares at a market price of 20, and they fully paid 20 shillings. So how do you compute the weighted average number of shares? Listen, it is obvious in the register of shareholders. Come the end of the year, you will have 3 million. We began the year with 2 million, but on 1st of July, we issued another 1 million. So it is obvious in the register of shareholders, you will have 3 million shares in issue. But to compute the weighted average number of shares for purpose of basic earnings per share, you don't use 3 million shares. No. As much as it's true, they were in the register, or they're in the register as 3 million, for purpose of earnings per share, you are required, listen to the key point now, you are required to multiply. In other words, we can say this: when shares are issued at full market price, they must be weighted. They must be weighted on time basis. This must be weighted on time basis. Weighted on time basis. That is the key important point. So if you are putting down a summary, you can put down a subtopic there at full market price. Then you just write the word, they should be weighted on time basis. That is the most important. They should be weighted on time basis. If you are putting down the summary of the key important point, that is the only important point when it comes to shares being issued at full market price. You're only required to remember that they should be weighted on time basis. Good. Is it me? I can't hear you. Are you able to hear me? Somebody says he's not able to hear me. Julie says he's not able to hear me, but some people are saying I am loud and clear. Is it loud and clear to the others? Is it loud and clear to the others? Julie says he's not able to hear me. Very loud. So Julie, find out maybe your speaker is not clear or your speaker. Good. So most people are saying loud and clear. Maybe it's your laptop. Check on the speakers. Good. Thank you. So let's continue. So I've said the only summary you are putting down is, we have said the subtopic is at full market price. Issue at full market price. You can even say here, issue at full market price. Then you just say they should be weighted on time basis. Okay, that's all. Meaning, listen, what does it mean to say on time basis? Listen to this now. Meaning you start with the number of shares that were there by the beginning of the year, 2 million. Then you'll come and say, during the year we issued another 1 million shares, multiply that by the time adjustment factor. We call it a time adjustment factor. The argument is this. Listen. Listen to the argument. Otherwise, you're not writing this argument. I'm only giving the argument why we multiply by the time adjustment factor. On 1st of July, I issued 1 million shares at a market price of 20. So these shareholders gave me an amount of 20 million. As a company, we received 20 million shillings. This money only financed me from July to December. As a company, your money financed me from July to December. So we normally argue by saying, why then should I give you earnings for the full year and yet your money did not finance me for the full year? Your money only financed me for 6 months. That's why we multiply that by 6/12, which is what we call the time adjustment factor. Good. Fine. So that's all I can say about number one. When shares are issued at full market price, they should be weighted on time basis. Good. We now go to number two. When we say issue at full market price, but partly paid. What is the rule? At full market price but partly paid. What is the rule? Something is wrong. Just a minute. Something is hanging. Okay. Sawa. It's okay now. So at full market price and partly paid. Meaning, listen, again, we could have begun the year with 2 million shares, but come 1st July, we issued 1 million shares whose market price was 20. Listen, but at the end of the year, these guys had only paid me 15. Shillings. I issued 1 million shares at a market price of 20. But come the end of the year, these guys had only paid me 15. How do I use them for purpose of computing the weighted average number of shares? Because we are revising, I want somebody to tell me in one sentence. What do you know on how to use partly paid shares? Somebody? How do we use them? Or what is the key important point? We issued 1 million shares on 1st July at a market price of 20, but maybe we were issuing them in installments, so they paid us only 15 at the end of the year. They are yet to pay me a balance of 5. So how do I use these shares to compute the weighted average number of shares? What is the most important key point? Somebody put down the key important point. I want to see when shares are issued at full market price and they are partly paid. How do you use them? What's the key important point? I'm waiting for somebody to put down the answer. I'm waiting for somebody to put down the answer now that we are revising. What do you do? Time apportionment. Okay. Alvin says time apportionment. I'll discuss it. That's not the key important point now. That's not the key. There is a key point. We are looking for the key of this item. Somebody else? When shares are issued at full market price, but they are partly paid. Okay. So we are saying, let me explain it. We say you only consider. Okay. Listen. You will ask yourself, don't write fast. Don't write fast. Later I will explain the point. We issued 1 million shares. Listen to this now. We issued 1 million shares at a price of 20, but these guys paid me only 15 shillings. So it means I received only 20 million shillings. Listen to this now. Listen to this now. If these guys were to use their 20 million to go to the stock market and buy shares, they cannot be allowed to buy shares by paying slowly. If they go to the stock market with their 20, the shareholders have paid me, no, sorry, not 20, 15. Sorry, they have paid me 15. That is 1 million times 15 shillings. So as a company, we have received only 15 million. But I'm saying this, if these shareholders were to use their 15 million and go to the stock market and buy the shares with their 15 million, they cannot be allowed to buy and pay partly. They will buy one share at 20 shillings. Listen. So we are saying with their 15 million, listen, that 15 million would be enough to buy how many shares if they were to use their money to go to the stock market and buy the shares. They can't buy 1 million. See, listen, as a company, we gave them the privilege to pay me the balance of 5 later. So they have paid me 15, but I've given them 1 million shares. Okay? I'm requiring them to pay me a balance of 5 shillings later. But if they were to go to the stock market, they can only buy 750,000 shares. Now listen. That 750,000 shares are the shares we say out of the 1 million. Listen, out of the 1 million, those are the shares. Somebody has already answered my question that I asked you. Thank you, Agnes. You have already answered it correctly. Now, those 750,000 shares out of the 1 million, those are the shares that are considered, listen, they are considered to be fully paid. Fully paid. So when shares, now I'm giving you the summary now. No, not the summary, the key point now. When shares are issued at full market price and they are partly paid, listen, you consider them, you consider the 1 million shares only to the extent that they are fully paid. Only to the extent that they are fully paid. In other words, out of the 1 million shares we issued, only 750,000 shares are considered to be fully paid. Those are the ones you're going to use for purpose of weighted average. So you will take your 2 million shares that were there by the beginning, add the 750,000 shares. Listen to this now. Then again, listen, you will argue by saying, but your money came in July. Your 15 million came in July. Why should I give you earnings for the full year when your 15 million did not finance me for the full year. Your 15 million only financed me for 6 months. So I must multiply this by 6/12. That's how we use them. But the key point, which if you are putting down number 2, the key point under number 2, we can say when shares are issued at full market price and they are partly paid, we can say they are considered. They are considered for EPS calculation. They are considered for EPS calculation only to the extent that they are fully paid. Only to the extent that they are fully paid. If you are writing the key point, that is what we are saying. Only to the extent. So somebody is saying, pardon sir, the 750 area. Listen, that is Felix. Now listen, Felix, you are saying, how did we get 750? I said, we gave these guys, or we issued 1 million shares at a price of 20. But come the end of the year, they had already paid me how much? 15. So how much was the amount received by the company? The amount received by the company was this 1 million times 15. This comes to 15 million. Are you getting? Then I have said, if they were to use their 15 million and go to the stock market, they will not be allowed to buy a share of 20 at 15. They can only buy a share at 20 bob. But they came to the company and we gave them the privilege of paying slowly. Okay? But if they were to go to the market and buy the shares, they will buy them at 20 bob. So this 15 million that they have given us, how many shares would it have bought? How many shares would it have bought if they were to go to the stock market? They would find one share being sold at 20. Okay? That means their 15 million would only be enough to buy 15 million divided by 20. That comes to 750,000 shares. So that 15 million is only enough to buy 750. Listen. But when they gave us the money 15 million, we issued them how many? 1 million shares. So out of the 1 million, we are asking ourselves, how many of them are considered to be fully paid? Only 750,000 shares. Only 750,000 shares are considered to be fully paid. Listen, maybe I can add another point here for the sake of the others. Listen, the moment they will bring me the balance of the other 5 million, remember they have paid me 15. They have yet to pay me 5 bob per share on their 1 million shares. They are yet to pay me another 5 million in the future. When they give me another 5 million in the future, now I'll give them the balance of the shares, which is how much? I'll give them the balance of the other 250,000 in the future. When they shall bring the balance of the money, I'll give them the balance of the 250,000 shares. Are you there? But for now, it's like I've given them only 750 to the extent that the 1 million shares are fully paid. It's only 750. I don't know whether Felix, you're okay now. Felix, you say yes or no? Good, fine. But don't forget, listen, don't forget, in the future, they will bring in the 5 million. I'll give them the balance of their shares. That's important. I'll discuss that later. Just note that in the future, you don't have to write it down, but just know that in the future, when they bring in the balance of 5 million, as a company, we shall issue them with the other balance. It's like we shall issue them with the other balance of 250,000 shares later. But for now, it's like we have issued to them 750,000 shares. Good. Fine. So you're through with number 2. I hope you have understood it. Where I've said shares are issued at full market price, but they are partly paid. The key important point is they are considered for EPS calculation only to the extent that they are fully paid. That is the key important point. Only to the extent that they are fully paid. Now listen, some books put it this way. Only to the extent Listen, only to the extent that they will participate in dividend. Only to the extent that they will participate in dividend. Listen, some books will put it that way. It's the same thing. Listen to this now. When you as a company, you issued 1 million shares at a market price of 15, at a market price of 20, and the guys paid you 15, listen, at the end of the year, a company, listen, a company does not pay dividends to partly paid shares. A company pays dividend only to fully paid shareholders. Only to fully paid shareholders. So it is like asking yourself this question. How many out of the 1 million shares will participate in dividend? Because dividends are not paid to partly paid shares. They are only paid to fully paid shares. So out of the 1 million, how many of them are considered to be fully paid so that they participate in dividend? That is what we are getting as 750,000. How did I get it? I took the amount received from the issue of the shares, which is 15 million. I divided that by the market price per share, which is 20 from this illustration, and I got 750,000. Good. So that's what we are trying to say. So in that case, therefore, 750,000 are considered to be fully paid, or in other words, you can say 750,000 are the ones that will participate in dividend come the end of this year. The others 250 will be considered, I will be participating in the following year when we receive the money. Good. Now we can go to number 3. Now we can go to number 3. I hope you have taken the key point there. When shares are issued at full market price, only to the extent that they will they are fully paid, or in other words, only to the extent that they will participate in dividend. Good. Number 3. When shares are issued as bonus shares. As bonus shares. Listen, again, let me assume we began the year with 2 million shares. On 1st July, you issued another 1 million shares as bonus. As bonus. What is the key important point? Somebody can put it down, chat, and tell me what's the key important point when shares are issued as a result of, through bonus. When shares are issued as bonus shares, I told you bonus shares are extra shares given to existing shareholders free of charge. Free of charge. So we gave them another 1 million shares free of charge. That's why I'm not writing 20 bob, because we are giving them for free. They are not paying anything on 1st of July. Good. Thank you, Ross. Not weighted. So the key point there is, you can even put it down. I hope you have written number 3 as bonus shares. They are not weighted on time basis. They are not weighted on time basis. That is the key important point. Of course, we have others, but for now, for purpose of computing the basic EPS, we say they are not weighted. Listen. Why are we saying you don't multiply that by 6/12? Yet we issued them in July. Remember, no money came into the company. So you can't tell them, oh, your money financed me for 6 months and so on. So why should I give you earnings for 6 months? Why should I not give you earnings for 6 months? No. We issued the shares for free. So listen. So when bonus shares are issued, any time during the year, listen, the assumption is they are assumed to be issued at the beginning of the year. They are assumed to be issued at the beginning of the year. That's why we don't multiply by 6/12. It will just be you're taking your 2 million shares plus 1 million shares. For purpose of that, you take 2 million plus 1 million, you get 3 million shares. Good. So you don't multiply by 6/12. No. So you will use 3 million shares too. Good. Somebody is already answering them. Good. Thank you, Peter. You are saying they are considered as if they were there at the beginning. Good. That's what I'm saying. The assumption is that they are assumed to be issued as from as from the beginning of the year. Good. So if they were issued at the beginning, then you don't multiply by, you could multiply by 12 over 12. That's the same one. Good. Wow. Now, what is this other key point? That's point number 1 for bonus. But there is also another key important point that you should remember concerning bonus is, listen, the EPS of the previous year. The EPS of the previous year should be restated. Should be restated. We normally say for comparison purposes. Listen, remember last year, we have assumed that the bonus were assumed to be issued at the beginning. So for purpose of comparison now, it will be required of you to assume, because they were issued at the beginning of the year, what would have been the earnings per share of last year for comparison purposes. Listen, let me use an illustration very fast. Listen, assuming the earnings last year here were 8 million. The EPS last year was 8 million divided by 2 million shares that were there. That was EPS of 4. That was our EPS. 8 million divided by 8 million divided by 2 million is 4 shillings. But now we are saying, when a company issues bonus shares during the year, they are assumed to be issued as from the beginning of the year, and therefore, for comparison purposes, the EPS of the previous year should be restated. Then the question is, how do you restate the EPS of last year? Because some questions tell you, number A, compute the basic EPS. Number B, calculate the restated EPS of the previous year. So you will take, to calculate the restated EPS, you will take the earnings last year, which from our illustration is 8 million. You now divide that by the number of shares last year, 2 million, plus the bonus of the current year, 1 million, which comes to how much? 3 million. So whatever is the EPS, like in this case, this will be, let me just assume I'm doing that calculation. I'm assuming I'm doing that calculation. You don't need to put it down. That is 8 million earnings divided by 3. That comes to about 2.66 or 2.67. So if the EPS of last year was 4, now we are saying for comparison purposes, it has been restated to how much? 2.67. So the point is that the EPS of the previous year should be restated. How? Listen, how? By dividing the earnings of the previous year, which is 8 million, divide by the number of shares in the previous year, plus the bonus share in the current year. So the last year shares were 2 million, plus the bonus shares this year 1 million, that gives me 3 million. So I'm through with the two important points. Two important points when it comes to bonus. One, they are not weighted on time basis. Two, the EPS of the previous year should be restated. How? That's not important for now. I'm only giving you the key points. Good. I think we can now go to number 4. How to compute the weighted average when something else takes place during the year. Good. So number 4 was what? Let me go back to my list so that we go by the list. According to the list, what was number 4? Number 4 is when shares are issued as a result of a stock option. Good. That was number 4, as stock option. Listen, again, we began the year with 2 million. Let me assume so. We began the year with 2 million shares. On 1st of July, your company issued 1 million shares as a result of a stock option. Good. Now you know, I told you, a stock option is a privilege given to the employees of the company to buy shares at a price below the market price. At a price below the market price. Listen, maybe the company market price shares was 20, but you gave the employees the privilege of buying them at 15. How do you use these 1 million shares, or how do you use them to compute the weighted average number of shares? You say 2 plus 1? No. So again, somebody come and put down the summary for me, the key point. In 1 or 2 words, I'll know. How do you use shares which are issued as a result of a stock option to compute the weighted average? Somebody put down the key point. Somebody put for me down the key point. I just want to see, now that we are revising, when shares are issued as a result of a stock option, that means the employees were given the privilege of buying shares and they bought. They bought 1 million shares at 15 shillings each, while the market price is 20. Yes, somebody? How do you use them? What's the key important point there? I'm waiting for somebody to give me the key summary point when shares are issued as a result of a stock option. We are revising. Deemed to be issued at full market price? Not really, not really. There is another point there. There is another point there. There is another point there. There is somebody called EW. There is another point there. Add some more points. Somebody else. We are revising. Yes. Somebody else who can remember? Deemed as bonus. You are adding. Good. So we combine your 2 points. You are the same one who has added the 2. Okay, so let me first explain before we shall put down the summary point. Listen to the explanation first before we put down the key point, because I want you to put down the key points so that when you are revising, you only remember the key points. Illustration is not important. You don't have to put down the illustration. You just need to remember the key points. But for me to explain the key points, let me use that small illustration. Listen. Today on 1st July, I told my employees, I am giving you the privilege of buying 1 million shares at 15 shillings each. And they paid me. So we received how much? 15 million. When we received 15 million shillings from them, we gave them 1 million shares. Listen. But if they were to go to the stock market with their 15 million shillings, they will not be allowed to buy shares at 15 bob like they have done in our company. They will only be allowed to buy them at 20 bob. Listen. So it means this 15 million they have paid us is not enough to buy 1 million shares. It's only a privilege you have given to them. But the 15 million is not enough to buy 1 million shares. It's enough to buy how many? So we take 15 million. If I divide that by 20 shillings per share, that means that 750,000 shares would have been bought. If we issued to them at 20, their 15 million was only enough to buy 750,000 shares. Now listen. But we did not give them 750,000 shares. We gave them 1 million shares. We did not give them 750, which ideally I should have given them. But we gave them 1 million. So the point is this now. It therefore implies, listen, it therefore implies out of the 1 million, it is obvious 750,000 shares out of the 1 million are considered to be issued at, they are considered to be issued at full market price. At full market price. Okay. They are considered to be issued at full market price. Listen. Then it is obvious, therefore, there is another 250,000 shares, which obvious as a company, we are going to give them as bonus for free. As bonus shares. So listen. So the key important point here is this. When shares are issued as a result of a stock option, then we normally say, don't try it first. We normally say some of those shares are deemed to be issued at full market price, and some are deemed to be issued as what? As bonus. So you must separate whichever the number of shares the company has issued. Me, in my illustration here, I'm assuming 1 million. But it can be any other number of shares the question will give you. But for now, we are assuming the company issued 1 million. How many of them are deemed to be issued at full market price? To get the number of shares, listen, to get the number of shares deemed at full market price, you take the amount received from the stock option, which is 15, you divide that by the average market price during the year. The average market price will be given by the question, which in my illustration here, we are assuming 20 shillings. So it means out of the 15 million shillings they have paid us, their 15 million was enough to buy only 750,000 shares. So those 750,000 are the ones deemed to be issued at full market price. And then you come back and argue by saying, but I'm not going to give them only 15 million. No, 750,000, sorry. I'm not going to give them 15,000 for 750,000. I promised them to give them 1 million. It's a privilege. So then it automatically also implies that some of them are given for free, which means 250,000 are given for free. So you will have to separate. Listen, when shares are issued as a result of a stock option, some are deemed to be issued as bonus, some are deemed to be issued at full market price. Listen, now that you know, listen, now you go back to the rule. You all know by now, I've already mentioned, when shares are issued at full market price, what do you do? What do you do? When shares are issued at full market price, what do you do? We said they should be, when shares are issued at full market price, they should be weighted on time basis. So these ones must be weighted. We have already discussed that in the first place. That was the first thing I talked about. Then here, when shares are issued as bonus, it was the third item, not weighted. Not weighted. That is already going by the rule that we have already mentioned. Not weighted. Good. But the point is this. Listen, I'm only putting down the key point now. If you want to put down the key point, we are saying when shares are issued, if you are saying that, when shares are issued, you can put down. I don't have time to write down, but you can say this. When shares are issued as a result of a stock option. When shares are issued as a result of a stock option, comma, some of those shares are deemed to be issued at full market price. Some of them are deemed to be issued at full market price, and some are deemed to be issued as bonus. Some are deemed to be issued as bonus shares. Good. Then you can say this. To get the number of shares deemed to be issued at full market price, get the number of shares deemed to be issued at full market price, get the number of shares deemed to be issued at full market price, we divide the amount received from the stock option, we divide the amount received from the stock option by the average market price per share, by the average market price per share during the year, by the average market price per share during the year. Another sentence, want to put down, another sentence, say this. The balance or the difference, put it this way, the difference between the number of shares issued, difference between the number of shares issued, difference between the number of shares issued as a result of a stock option, as a result of a stock option, difference between the number of shares issued as a result of a stock option and those deemed to be issued at full market price, and those deemed to be issued at full market price, and those deemed to be issued at full market price represents the bonus share element. Represents the bonus share element. Represents the bonus share element in the stock option. Represents the bonus share element in the stock option. That cut to 50. That's what I'm talking about. It represents the bonus share element in the stock option. Good. Now another paragraph. Another paragraph. Those deemed to be issued at full market price must be weighted. Those deemed to be issued at full market price must be weighted on time basis. Those issued at full market price must be weighted on time basis. And those issued as bonus are not weighted. And those issued as bonus are not weighted. Are not weighted on time basis. Are not weighted on time basis. Are not weighted on time basis. Good. Now listen. Which means, let me now continue. Let me continue. Which means, we began the year with that 2 million shares, Tasema plus 750,000. But the money did not come at the beginning. The money came in July. So we multiply that by 6/12 plus the bonus, the 250. You hauta weight. Uta multiply by 6/12. This is bonus. They are never weighted. So that's how you use the bonus share as the stock option to compute your weighted average. Take the number of shares that were there by the beginning, 2 million, plus those deemed to be issued at full market price, 750,000. Then you must multiply that by the time adjustment factor, which in our illustration is 6/12. Then you add the bonus element, which is never weighted. Good. Now listen to the second point. Listen, you also know. Listen to this now. You also know when shares are issued as bonus, the EPS of the previous year should be restated. EPS of the previous year should be restated. Of course, for comparison purposes. That is another key important point you can put down. The EPS of the previous year should be restated. Let me remind you. Listen, I'm reminding you again. I'm reminding you again. How do you use them? Why, by the way, listen, why do we have to restate the EPS of last year? Remember, there is bonus. In bonus, we say that assumed to be issued at the beginning. Don't forget that. Just like when I was discussing the bonus element, and I said the EPS of last year should be restated. Last year, our earnings were 8 million. We divided that by the number of shares last year, 2 million. That came to be 4 shillings per share. This was 4 million, 8 million, sorry, earnings. Maybe the number of shares last year was 2 million. Now listen, now that this year we issued another 250 for free as bonus, the EPS of last year should be restated. How? You divide the earnings last year, 8 million, divide that by the number of shares last year, which is 2 million, plus the bonus element. This is 2 million, plus the bonus share element in the current year, which is 250, which in my illustration here will be 0.25 million. This will be 8 million divided by 2.25 million. That's how you compute the weight, the restated EPS. You take the earnings last year, that does not change, but you divide that by the number of shares last year plus the bonus element in the current year. Don't forget, when we had bonus of 1 million, we added 1 million. But this year now, out of the 1 million, only 250 are considered as bonus. Good. But I think we are through with number 4. Now. If you're okay, we can now move on. That has too many points. Stock option has too many points, and it's also common in your exams, very common in your exams, where you find shares were issued as a result of a stock option, because there are too many things to remember there. One, how to separate the number of shares deemed to be issued at full market price, those issued as bonus. You have to remember that. Two, you have to remember that those issued at full market price are weighted. Those not issued at full market price are never weighted. And you have also to remember the EPS of last year should be restated for comparison purposes. How? By dividing the earnings of the previous year, divide that by the number of shares in the previous year, plus the bonus share element in the current year. Good. If you're okay, we can now proceed to number 5 now. We are through with number 4, which is the stock option. Good. So let's now move on to number 5. If you are okay with it, don't forget we are reviewing the topic first before we do a question. So that once I do the past paper question I want us to do, the 2 questions I want us to do, then it will be that will be giving me the facts as we move on. It becomes faster. Now, number 5, when we have shares asked, no, when shares are issued as a result of a rights issue. As rights issue. Rights issue. How do you go about it? Let me again move on. We are assuming we began the year with 2 million. On 1st July here, our company issued 1 million shares. Listen. To who? To the existing shareholders. We give them the privilege to buy extra shares at a price below the market price. When the market price was 20, we gave our existing shareholders the privilege of buying them at 15. Listen to this now. Do not confuse stock options with the rights issue. They appear the same, but the rules are different. Yes, both of them are privileges to buy shares at a price below the market price. Both of them, that is the stock option and the rights issue. But the workings are totally different. You know, stock option is a privilege to employees. Rights issue is a privilege to existing shareholders. Okay? So again, how do you use them to compute the weighted average? Now listen. Just like the stock option, listen to this now. Just like the stock option, again, it is deemed that some of these 1 million shares are deemed to be issued at full market price, which must separate, and some are deemed to be issued as bonus. So you are again concerned is to ask yourself, how many out of the 1 million shares are deemed to be issued at full market price? The question is, listen to the question now, how do I determine those shares that are deemed to be issued at full market price? Do you determine, listen to the question, do you determine them the same way we determined the ones as stock option? The answer is no. When it was stock option, I want you to check. When it was stock option here, I took the amount received, which was this 15 million amount received here. This was amount received, 15 million. I divided that by the market price per share to get the number of shares deemed to be issued at full market price. But when it comes to a rights issue, when it comes to shares being issued as a result of a rights issue, you don't take, listen, as much as it's true, we also received 15 million. Don't forget, even now, for this one, we still received 15 million. How did I get 15 million? 1 million shares times 15 shillings. That's what they paid us. So as a company, we still received 15 million. But now you don't divide that by 20 shillings per share like we did for stock option. What do? How do you determine the number of shares deemed to be issued at full market price? Somebody put down a statement. I'll be able to know. Somebody just put down one sentence. I'll be able to know whether you are getting the point or whether you can remember the point. When shares are issued as a result of a rights issue, what's the key in point on how to get the number of shares deemed to be issued at full market price? Somebody put down. I want to know, out of the 1 million, how many of the 1 million shares are deemed to be issued at full market price? What do I do to get the number of shares at full market price? Somebody? Yes. Good. Thank you, Lisa. You are saying we compute what we call the theoretical ex-right price. Good. We compute what we call the theoretical ex-right price. Listen, let me explain to this. We are a public company. Before the rights issue, listen, before the rights issue, we had 2 million shares which were in the market. One share had a market price of 20 shillings before the rights issue. Follow me now. So if before the rights, we had, don't write, 2 million shares. Let me use figures of thousands. 2,000. This is before rights. One share had a market price of 20 shillings. Listen. So it means before the rights issue, our market capitalization as a company, our market capitalization of a company was 40 million. 2 million times 20 shillings is 40 million. Now, listen to this now. We issued another 1 million shares as a result of a rights issue. We gave the employees the privilege, we gave the existing shareholders the privilege to buy 1 million shares and they bought. Listen. So it's like we are floating another 1 million shares in the market. Before the rights issue, there were 2 million shares in the market, which were fetching a market capitalization of 40 million. Listen, you all know the law of supply and demand. The law of supply says the higher the supply of any commodity, the lower the price. When you increase supply of a commodity, we expect the price of that commodity to come down. In our market, we had 2 million shares. The market price was 20. Okay? Now we are increasing the supply in the market by another 1 million shares. We expect the price to come down as from 1st of July. What is that price that is expected to prevail after 1st of July? In other words, what is that price that is expected to prevail after the rights issue? The price that is expected to prevail after the rights issue, that is the price we call the theoretical ex-right price. The price that is expected to prevail after the rights issue. Listen, how do we get it? We have issued 1 million shares at a price of 15. Listen, so these guys gave me another 15 million shillings. So it means, listen to this now, it means after the rights issue, our company will have 3 million shares in the market. Those 3 million shares will be fetching a market capitalization of our company amounting to how much now? 55 million. So what is the price that we expect to prevail? So what you will do, you will get what we are calling the theoretical ex-right price. How? By dividing, listen, by dividing the market capitalization of your company after the rights issue, by dividing the market capitalization of your company after the rights issue by the number of shares after the rights issue. That's how you get the theoretical, the expected price that is expected to prevail after the rights issue. Good. Let me use my calculator here. I take 55 million. I divide that by the number of shares in the market now after the rights issue, which is 3 million. So I expect the price will come down to 18.3 to 1 decimal point. Good. Listen to this now. So we expect that after 1st of July, the market price of the shares will go down to 18.3, sorry. Now listen to this now. Then after that, you will argue by saying, listen, we issued 1 million shares to these employees, no, to these existing shareholders at a price of 15 per share. We issued 1 million at a price of 15. So they brought in 15 million. Listen, they brought in 15 million. This 15 million that they brought in, we expect now the price to be 18.3. So this 15 million would have been enough to buy so many shares after 1st of July. So listen, so you now don't divide by 18, no, you don't divide by 20 like I did for stock option. You now don't divide by 20. Don't forget, stock option don't go to the public. It's employees you give the privilege. But rights issue is when you are issuing more shares to the public. Existing shareholders, you are floating the shares, which means they will be trading in the public. So we are saying this 15 million, if they were to go to the stock market and buy shares, they would find one share now going for 18.3. So the number of shares deemed to be issued at full market price now would be at full market price would now be 15 million. Divide that by the expected price, which is 18.3, which now comes to how much? So let me take my 15 million. I divide that by 18.3. We have, I'm rounding off my shares. It will be 18 million, it will be 819,672,000 shares. 19,672 shares are the ones deemed to be issued at what? At full market price. So it is obvious at full market price, it will be 819. This is 819. 672 as bonus shares will be a balance of how much? Let me minus from a million. Looks like 180. 328. No, 328. Good. Are we together so far? Are we together so far? Somebody say yes or no. Are we together so far? How to separate? That is important. How to separate the number of shares deemed to be issued at full market price when it is a rights issue. I have said you first compute the theoretical ex-right price. How do you get that theoretical ex-right price? I have said you divide the market capitalization of your company after the rights issue, divide that by the number of shares after the rights issue. That will give you the expected price that will prevail in the market after the rights issue. Once you get that now you divide the amount received from the rights issue by the theoretical ex-right price to get the number of shares deemed to be issued at full market price. Then, of course, the difference between the shares issued as a result of a rights issue and those deemed to be issued as at full market price, The difference is what we are calling what? Bonus. Listen again. The key point also remains, don't forget, when shares are issued at full market price, the rule says what? They must be weighted. Those issued at full market price must be weighted on time basis. Those issued as bonus, not weighted. Not weighted. Good. Listen, which means, same argument, take your 2 million shares plus 819,672, multiply that by the time the money came in July, so it will be 819,672 times 6/12 plus the bonus element, that is 180,328. Good. That's how you compute the weighted average. Yes. Good. What do you mean by we weight the full price? I'm not getting you, Grace. Grace, you're saying something. What do you mean by full price? Grace, what do you mean by full price? You have said, do we weight the full price? What do you mean by the full price? It's the number of shares, not price. It's the number of shares. We don't weight the price, we weight the number of shares. I had to separate. Listen, out of this 1 million shares, how many were deemed to be issued at full market price? And that is what we have got as 819,672. Then the difference between 1 million and that, then the difference ngoja Philip ngoja kwanza nitakujibu yako baadaye. Wacha kwanza to understand Grace. Once you now get the number of shares deemed to be issued at full market price, which is 8, separate from the 1 million, you might get this. Then I have said, the rule of shares issued at full market price, it does not matter whether they were issued on their own or together with another component. We have started, and we started with the bond shares issued at full market price. And I said the key point is they have to be weighted. That was the rule. Good. So you are weighting the number of shares, these ones. We are not weighting the price. The price was the theoretical. It was only helping us. It was only helping us. The theoretical ex-right price, we were saying, what is the price that is expected to prevail after the rights issue? That's the price you calculate. Then you take the number of shares, the amount you received, which is this 15 million, you divide by that theoretical ex-right price. By arguing this way, I say, we received 15 million as a company at a time when we expect the market price to be 18. So if they were to go to the stock market with their 15 million, they can't buy 1 million shares because we expect the prices to go down to 18.3. So this 15 million, if they were to go to the stock market, they will buy how many shares using their 15 million? If the price is expected to be 18, they are only expecting to buy 819,672. Those are the ones I'm going to say I consider them to be issued at full market price. But then, when they brought in this 15 million, we did not give them 19,000 shares. We gave them 1 million. So it is obvious, it is considered that some of them also were given as free out of the 1 million. If out of the 1 million, 819 are considered to be issued at full market price, then it means the other 180,328 are the ones deemed to be issued as bonus. Once you separate the 1 million that way, now you know the rule of shares issued at full market price. The rule says they must be weighted. You know the rule of bonus. Owner says they are not weighted. Grace, are we okay now? Grace, I'm asking you now. Are we okay, Grace? We continue? Or I was asking if we would still wait after the theoretical. I get it now. Good. The rule remains. Good. Thank you, Grace. You have said the rule remains. Now you are getting. Now I'm okay now. Good. Thank you. Sawa. Let's proceed. Now let us answer who? It was Philip. Do we restate using the bonus? Now, that's a question to the others. Now, listen. Philip is asking, now that there is an element of bonus, anytime there is bonus, it is a requirement that the EPS of the previous year should be restated. Now, listen. Let me take you to stock options. When I was dealing with stock options here, you can see my calculation on the left in red. I restated the EPS of last year this way. I took the earnings last year 8 million. I divided them by the number of shares last year 2 million plus the bonus element in the stock option, which was how much? 250. So I divided 8 million by 2,250,000. Now the question is, listen to my question. Now the question is, yes, the earnings last year were 8 million. The number of shares last year was 2 million, which automatically means the EPS last year was 4 million. 4 shillings, sorry. Does it mean that again, to restate the EPS of last year, I'll take the earnings of 8 million, I divide that by 2 million plus the 180 plus the 180 as I did for stock option? The question is, will I take the 1 million, the 2 million, sorry, last year plus the bonus this year of 180? Somebody say yes or no? Just yes or no. To restate the EPS of last year when it is a rights issue, the question is, do I take the earnings last year, divide by 2 million plus the 180? Yes or no? Yes or no? I'm waiting. Because we are revising. How do you restate the EPS of last year when it is a rights issue? Do you deal with it the same way we have dealt, or we dealt with the stock option? Yes or no? I'm waiting, please. Wait, we want to do a question. So the more you keep me, somebody I think has already answered. The answer is no. Thank you, Stella. Thank you, Stella. Now listen. No. Thank you, Eliza. Thank you. Now listen. When it's a question of a rights issue, you restate the EPS of last year. How? To get the restated EPS here, listen, you will take the EPS of last year itself, which was how much? 4 shillings. Listen to this now. You take the EPS of last year, 4 shillings, and restate it by multiplying it. It means the 4 shillings. By multiplying it by a factor. What is that factor? Listen, the factor is you multiply that by what we call the theoretical. This is the theoretical X, right price. You divide by what we call the actual term, right price. So to restate the EPS of the previous year, when it's a rights issue, you restate it. Which one? The last year EPS. You restate it by multiplying it by a factor. That factor is what I'm putting it here. Let me put it in black so that it's seen clearly. I've said You multiply that by the theoretical, the factor is the theoretical, X right price. You divide that by the actual. Divide by the actual right price. Like in our case here, it is 4. What was our theoretical X right price? It was 18.3. We divide that by the actual right price before the rights issue. What was the price? It was 20. What becomes the restated EPS of last year? Let me just do it for the purpose of illustration. This would be 4 shillings times 18.3. Divide that by 20. This comes to 3.66. That's how you restate the EPS of the previous year. That's how you restate the EPS of the previous year. Good. I hope everything is okay now. So do not, my appeal is, do not confuse stock options with the rights issue. As much as they sound the same, the workings are different. The concepts are the same, but the workings are different. Can we proceed? Can we proceed? Let me just summarize. Oh, I don't know whether we have summarized the key points. Oh my, there were a lot of things. Okay. I don't think I've put down the summary points for rights issue. Okay, maybe you could put it down this way. Put down the summary key point. The summary key point, put it this way. Put down the summary key point. Sema hivi, when shares are issued as a result of a rights issue, shares are issued as a result of a rights issue, comma, some are deemed to be issued at full market price, and some are deemed to be issued as bonus. That's shares are issued at full market, as a result of a rights issue, comma, some are deemed to be issued at full market price, some are deemed to be issued as bonus shares. Okay. Another paragraph. To calculate the number of shares deemed to be issued at full market price. To calculate the number of shares deemed to be issued at full market price. To calculate the number of shares deemed to be issued at full market price, comma, first calculate the theoretical X right price. 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 Continue. This is the price that is expected. This is the price that is expected to prevail after the rights issue. This is the price that is expected to prevail after the rights issue. This is the price that is expected to prevail after the rights issue. This is the price that is expected to prevail after the rights issue. Please stop. It is determined. It is determined by dividing. It is determined by dividing. It is determined by dividing the market capitalization of the company after the rights issue. Is determined by dividing the market capitalization of the company after the rights issue by the number of shares after the rights issue. by the number of shares after the rights issue. By the number of shares after the rights issue. Okay? Then you see this, the paragraph. The paragraph. To get the number of shares deemed to be issued at full market price. Get the number of shares deemed to be issued at full market price. We divide. Get the number of shares deemed to be issued at full market price. We divide the amount received from the rights issue. We divide the amount received from the rights issue. Remember, our amount was 15 million. We divide the amount received from the rights issue by the theoretical X-right price. By the theoretical X-right price. By the theoretical X-right price. Good. Another paragraph. The shares deemed to be issued as bonus. Shares deemed to be issued as bonus will be. Shares deemed to be issued as bonus will be the difference between. Shares deemed to be issued as bonus will be difference between the number of shares issued as a result of a rights issue will be difference between the number of shares deemed to be issued as a result of a rights issue. Shares issued. Say the bonus will be difference between number of shares issued as a result of a rights issue and those deemed to be issued as bonus. No, sorry. Those deemed to be issued at full market price. Sorry. Those deemed to be issued at full market price. Said bonus is determined the difference between number of shares deemed to be issued as a result of rights issue, it was our case 1 million, and the number of shares deemed to be issued at full market price, which was coming to about 19 something. Good. Another paragraph. Those issued at full market price should be weighted. Those issued at full market price should be weighted on time basis. Those issued at full market price should be weighted on time basis. And those issued as bonus are never weighted. And those issued as bonus are never weighted. Another paragraph. The EPS of the previous year. The EPS of the previous year should be restated. EPS of the previous year should be restated by multiplying it by the following factor. The EPS of the previous year should be restated by multiplying it by the following factor. Andika equals to theoretical X-right price divide by actual cum right price. Divide by actual cum right price. Good. I think we are now through. Now we can go to the next one. We have put down the summary key important points. There are many which you have to remember about the rights issue. It's very common for students confuse stock option and rights issue. I've always done a question, and it's a question of rights issue. When I'm asking students to give me the number of shares deemed to be issued at full market price, they do it very fast. They just take the amount received divided by the market price as if it was a stock option. Don't confuse. Don't confuse the rights issue and stock options. Stock option, it's lighter. Rights issue is a bit heavier because you must compute the theoretical first. Are we able to continue now? Can I continue? I think so. Somebody say yes. Can we continue? Good. Fine. Thank you, Felix. Now we can continue. Good. I hope you are together so far. I hope you are benefiting. This is a review in summary. Good. So now we go to number 6. Share split. When shares are issued as a result of a share split, what do you do? Let me explain. We began the year with 2 million shares. On 1st July, let me say this. We began the year with 2 million shares of 10 each, of shillings 10 each. Our company began the year with 2 million shares of shillings 10 each. On 1st of July, there was a share split in the ratio of 2 shares for every one. We did a share split in the ratio of 2 for every one. My question is this to you. It means from 1st July, when you go to the register, from 1st July, when you go to the register, you will find how many shares. Before we did a split, we had 2 million shares. But come 1st July, we did a share split in the ratio of 2 for every one. My question is, when you go to the register of shareholders on 1st of July evening, you will find how many shares there? Somebody write. How many shares will you find in the register? What? What? Some are saying 3, some are saying 4. We did a share split in the ratio of 2 for every one. Yes, somebody, yes. I'm not saying 2, 3 correct. I'm not saying 4 is correct. Let me get one more opinion. One more opinion. After 1st of July, when you go to the register of shareholders, you will find how many shares in the register. Some have said 3, some have said 4. Somebody else, I want one more comment. I'm waiting for one comment. Whether right or wrong, it doesn't matter. I just want to see one more comment. Peter says, I change to 4. Oh, Peter, sawa. You are right. Peter, you are right. Initially, you are wrong. What had you said initially? Let me see. Peter had said 3. Now she is changing and saying 4. You are right. Now listen. We issued 2 shares for every one. That's what we did as a split. Meaning we took 1 share on 1st July, we split it into 2. That's what we call a share split. If we are doing a share split in the ratio of 2 for every one, it means July we issued 2 shares for every one. Ukiwa na moja on 1st July morning, it means in the evening you'll have 2. They will take your 1 share and we make it 2. That's why we are saying we issued 2 new shares for every one. We did a split in the ratio of 2 for every one. For every one. So it means unaongezwa another one more. Ulikuwa na moja, inafanywa mbili, now you have two in the evening. In the morning you had one, then they did a split in the afternoon. In the evening you will have two. So what does that mean? Ni kusema, listen, umeongezwa the same number of shares ulikuwa nayo. Ulikuwa na moja, ukaongezwa another one. Mwenye alikuwa na 5 ameongezwa another 5. So it means, listen, from today onwards, the company will have 4 million. So actually we issued how many? We issued another 2 million on 1st July. We doubled your shares by giving you an extra number of shares, same as what you had before. But what is important is this. So on 1st July, we issued another 2 million shares. So that from July, now our company will have 4 million shares. But what is important is this. The capital of the company does not change. We began the year with 2 million shares of 10 each. So it means our capital is 20 million shillings on 1st January. Even after July, which means even by December, our capital will still be 20 million shillings. But don't forget, listen, don't forget now, we have 4 million shares in December. We began with 2 million. The company did a split. They gave us another 2 million. So by the end of the year, we have 4 million shares in the register. Yet I'm saying the capital does not change. So what changes? Listen. It means now from 1st July, 1 share of your company will no longer have a par value of 10. Your company will have a par value of 5. Listen. So when we issue shares as a result of a share split, listen, we normally say more shares are issued at a lower par value. Shares are issued at a lower par value. So 1 share now will have a par value of 5 from 1st of July. The capital does not change. The capital still remains the same 20 as it was in January. So December it will still be 20 million. But the number of shares now will be 4 million. The par value is the one that changes. So it means 1 share will have a par value of 5. That means our capital will still remain 20. So we normally say when shares are issued as a result of a share split, then more shares are issued. Listen, more shares are issued of a lower par value. So in other words, from July, shares are issued at a lower par value of 5. But what is important is this. Come July, we issued 2 million. Listen, did we ask them to give us any money? We gave them an extra 2 million on 1st July. They had 2 million shares. We did a split on 1st July. We gave them another 2 million so that they have 4 million from now onwards. But did we ask them to bring in the money for the extra 2 million? No. Listen. So the point is this. When shares are issued as a result of a share split, they should be considered as bonus shares. What was the rule for bonus? Same rule for bonus. Same rule for bonus. So it's that the point I can say. Everything for bonus, same rule. What is the rule? Not weighted. Not weighted. On time basis. Why? Because we said they are assumed to be issued when? As from the beginning of the year. Then what was the other rule for bonus? EPS of the previous year to be restated. That one I don't have to repeat it. I've already explained it when we were discussing the bonus. You take the earnings last year plus the number of shares last year plus the bonus element in the current year. Same. Are you there? Good. That's all we can say about share split. It doesn't have many complication. It doesn't have many complication. It doesn't have many complication. The only thing I can mention is this. Listen to my question. We began the year with 2 million shares. On 1st July, we did a share split. Listen to my question. Did a share split in the ratio of 1 for every 2. 1 for every 2. So if you go to the register after 1st of July, you'll find how many shares. Now answer me now. On 1st of July, we did a share split in the ratio of 1 for every 2. So on 1st July onwards, we shall find how many shares in the register. Good. Thank you. Now you are getting my point. Now you are getting my point. Good. So we are consolidating. This time, listen. This time we are consolidating the shares. We are trying to consolidate. We had 1. No, you had 2. We are issuing 1 share for every 2. So we are taking 2 shares and consolidating them as 1. So we give you 1 share for every 2 of yours. So we normally refer to this. Listen, we normally refer to this scenario as a reverse. We normally refer to it as a reverse split. Reverse. Is that the way? Reverse split. Where you consolidate your shares. It's not a common thing in the exam, but you may find a scenario where instead of increasing the number of shares, you consolidate the number of shares. Meaning, listen, we had 2 million shares of 10 each. That means the capital is still 20 million. Don't forget. Come the end of the year, our capital will still be 20 million. But now from 1st July, listen, our shares are no longer of 10. We are consolidating. We are consolidating 2 shares and making it 1. So from 1st July, our par value will be 20. Are you getting? So it means we shall have 1 million shares, not 2 million again. 1 million shares of 20 shillings each to give us 20 million. So in a reverse split, we consolidate the number of shares, meaning we increase the par value. We increase the par value. But most of your questions come with a normal split where you issue more for every 1. Issue 5 for every 1. Issue 3 for every 1. Issue 4 for every 1, and so on. That way you are splitting the shares and increasing the number. Otherwise, when you are consolidating, you are issuing 1 for every 2, 1 for every 5, 1 for every 4, and so on. Good. I think we can now continue. We are through with the share split. I've only said when shares are issued as a result of a share split, they are treated as bonus shares. 1, they are not weighted. I hope you have put down that key point. 1, they are not weighted. 2, the EPS of the previous year should be stated as the way the bonus was done. Good. I've already given you the discussion of the bonus. I don't have to go back and restate how to restate it. Everything remains the same. Good. Now we go to the next one. That is number 7 now. Conversion of debentures to preference shares. When shares are issued as a result of conversion, what do? When shares are issued as a result of conversion, what do? Let me discuss that very fast. Does nothing much. We began the year on 1st of January with 2 million shares. Listen, many years ago, we issued convertible debentures or we issued convertible bonds. Convertible debentures or convertible preference shares. From all those years, these guys had never exercised their right to convert. But come July this year, they decided to exercise their right. They decided to exercise their right and they converted their debentures or preference shares into ordinary. Suppose we issued them another 1 million on 1st July. What's the rule? Listen, when shares are issued on conversion of preference shares or debentures into ordinary shares, the only key important point you should remember is that they are weighted. They are weighted on time basis. They are weighted on time basis. Meaning, you will take your 2 million time basis. You will take your 2 million shares plus 1 million times 6/12. Let me explain why we have to weight them. Why do we have to weight them? Listen. Listen. These guys have already been earning a return. Before they converted their debentures into ordinary, the debenture holders were already earning interest from January to June. The preference shareholders were earning dividend from January to June. Then they converted. The argument is, why should I give you earnings again for the whole year when you have already been earning your dividend preference or you have already been earning your debenture interest? So that's why we are saying, I can't give you earnings for the full year. Because already you are earning something. You as debenture holders, you as preference shareholders, you are already earning something. Why should I give you again for the full year when you have already been earning? That's why we have to say, when shares are issued on conversion of preference shares or debentures into ordinary shares, they must be weighted on time basis. That's all. Okay? So there is nothing else we can add there. Just remember, they have to be weighted on time basis. That's important. Good. We go to the last one. We go to the last one, and that is when shares are issued as a payment. As a payment of the purchase consideration. Payment of purchase consideration in a business acquisition. In a business acquisition. How do you deal with that? That's what I want to talk about. Okay, now listen to my point. We began the year with 2 million. Listen to this. On 1st July, listen to this. On 1st July, as a company, we acquired a subsidiary. We acquired a subsidiary company. We agreed with them that the purchase consideration will be settled by issuing to them ordinary shares instead of paying them cash. As a company, to pay the purchase consideration, we issued those shares on 1st September. That's when we issued the 1 million shares as a payment of the purchase consideration. The question is this. When I'm computing the weighted average number of shares, will I take 2 million plus 1 million multiplied by 6/12, or I will take 2 million plus 1 million times 1, 2, 3, 4. September, October, November, December. September, October, November, December. 4 over 12. Which one is correct? Which one is correct? The first or the second? One, listen, one, they have to be weighted. But the point is, listen, am I going to weight them as from July or as from September? Somebody answer me now. From July or September? Will I have to weight them as from July or from September? Okay. Let me repeat. I'm not saying you're wrong. Don't get me wrong. I'm not saying you're wrong. I'm not saying you're right. Some have said July, some are saying. But I want you to understand this. I acquired my subsidiary company on 1st July this year. We agreed the purchase consideration will be settled by issuing 1 million shares. Me as a company, holding company, I issued those shares on 1st of September to pay my purchase consideration. Listen to my other question now. Listen to my question now. When I'm consolidating the results of this subsidiary, for example, let's assume in the income statement, you know that. When you're consolidating the P&L account of the group, we normally take the sales of the holding company plus the sales of the subsidiary. We acquired this subsidiary company on 1st July. But to pay their purchase consideration, I gave them 1 million shares in September. Question is, listen to my question now. Will I consolidate this subsidiary of mine from July or from September? Now put it down. When I'm consolidating my subsidiary, will I consolidate it from July or will I consolidate it from September? Very good. Very good. Everybody's getting it. You will consolidate it from July, the day you acquired it. 6 over 12 of the sales of the subsidiary. Good. Whatever you get become the group sales. Now listen. So it means it does not matter when you are paying your debt. The debt occurred on 1st of July, not 1st of September. Your debt is incurred, you incurred a debt on 1st of July, not September. Though you paid your debt in September by issuing the shares, but we consider them, listen to this now, you consider them as from the date of acquisition, not the date of the issue. So when shares are issued, the summary point is this. When shares are issued as a result of, as a payment of the purchase consideration in an acquisition of a business, we normally say they should be considered as from the date of acquisition, not as from the date of the issue. Why? Because the subsidiary's results will also be consolidated from the date of acquisition. Are you there? Good. So it is the first working here that was right, not the second. So when you issued the shares, that does not matter. But when did we incur debt? 1st July. That is the same date we shall consolidate our subsidiary. Okay? Good. Therefore, saying it is from the date of acquisition. So maybe you can put down this summary. We are discussing number 8 as a payment of the purchase consideration in a business of acquisition. When you say this, such shares should be considered. Such shares should be considered as from the date of acquisition. Such shares are considered for EPS calculation. Put it that way. These shares are considered for EPS calculation as from the date of acquisition as from the date of acquisition and not the date of the issue. And not the date of the issue. And not the date of the issue. Okay. I am through. Listen to this now. I'm through with my discussion about basic earnings per share. I'm through with my discussion about how to calculate the basic earnings per share. I told you the denominator is the key issue. Numerator is nothing difficult. Just take profit after tax, you minus preference dividends, get the earnings attributable to the ordinary shareholders, divide by the weighted average. How to get those weighted average number of shares is what I've discussed in detail. I thought I'll be able to go through the key issues that affect what we call diluted EPS so that we can do the questions that I want us to do. In your past papers, there are very few questions that only ask you about basic. Most of them ask you number A, basic, number B, diluted, because the questions are combined information to allow you to compute both basic earnings per share and the diluted earnings per share. So maybe for today what you will do, you will allow me to stop there. Next lesson, I will review again. That is not much. Diluted earnings per share will take me 20 minutes to review. Then we do the question. Diluted earnings per share will come together with what you have already discussed. So you will allow me to stop there for today. Then next time, we will review how to compute diluted earnings. Maybe you can even be reviewing it on your own. That was good. Thank you. That was good. Thank you. That's what I'm saying. I hope you have benefited on our revising the computation of the basic. Somebody said that is Stella. Said yes. Yes. Eliza says well understood. Thank you. Well understood. Rose says well explained. Thank you. Somebody called Hassin says thank you, Mwalim. Fine. Good. Now. Good. Thank you. Perfect. Thank you, David. You're saying perfect. Thank you. So next time we discuss the diluted earnings per share, we shall do two questions. We shall do two questions from your past papers, most recent ones. Those are what we shall do. Much appreciated, sir. Now, listen. Some of you are watching me and listen to this now. Some of you are watching me and you have not joined our classes. Maybe you have joined our classes and you have friends who want to join the online classes. Listen, tell your friends that we have online classes for the advanced financial reporting. Tell them we have online classes for financial reporting of the intermediate level. We also have online classes for financial management of the intermediate level and financial accounting of the foundation level. Tell your friends that we have those 4 subjects which we are offering online classes for. Now listen, some of you may not be able to join the live class. Some of you may not be able to join the live class. So if you are not able to join the live class, tell them that they can buy what we call the pre-recorded videos for the whole syllabus, whereby they can be able to watch them at their own free time, at their own pace, and whenever they have a question, they can call me anytime. Tell them if they want to reach me, they can reach me on this number, 0722-658875. Now, for everyone now, currently we are doing our block release. That's why we have reviewed the topic first, where we do the past paper. So if you have not joined our block release, please call me. We have, of course, by now, listen, okay, we are charging for block release 1,800 for the period of revising. We have already covered two lessons. You can still get the videos of the classes we have already covered. You can still get the videos of the classes we have already covered for block relation. Okay. The other thing is Some of you, even at this point in time, they may feel, listen, they may feel that they want the content of the subject, so they may prefer to buy the pre-recorded videos. It's not late to buy the pre-recorded videos. We have those videos at a special price. You can call me on that number, which is 0722-658875. Okay, good. Now listen. For those of you who are watching me through the YouTube, some of you are watching me through the YouTube, some of you are watching me through Zoom. Those which are watching me through YouTube, please go and click the subscription button if you have not subscribed to my YouTube channel, so that you can be notified whenever we post new videos into the YouTube. So go and click that subscription button down there so that you subscribe to my YouTube channel, so that we can notify you whenever we post new videos into the YouTube. Okay, my YouTube channel is called CPA Joseph Juguna. My YouTube channel is called CPA Joseph Juguna. Okay, you can also click that like button. Click that like button to like the video. We hope you have understood something today, which most of you have said yes, that you have understood. Peter said, well understood. There is another one said, I never understood this before. That is who? Charlene. I never understood this before. At least I'm getting something. I'm getting something. So for those who are watching me through the YouTube, click that like button. Click that like button. For those who have not joined the block, you can join the blocks for this match. You'll get the videos we have already covered. I've also said, tell your friends that we are offering online classes for those 4 subjects. That is advanced financial reporting of the advanced level, like the one we are doing today, financial reporting of the intermediate, financial management of the foundation, the intermediate level, financial accounting of the foundation level, and the one of ATD1 and ATD2. They also have financial accounting there. Then I've said, if they are not able to join the live class, they can buy the pre-recorded videos and watch them at their own free time. Good. So communicate or call me or text me on that number 0722-658875. For those who need the country code, is 254-722-658875. If you are here and you have not joined blocks and you wish to join, I've said we are currently charging 1,800 for the block revision. Then those who are watching through the YouTube, click that subscribe button and subscribe. Of course, you can also go and watch some more videos which are there for public. Not all of them. They are not all of you there for. There are some of which are there for promotion. You can go and watch them from the YouTube channel. Then I've said you click the like button if you have understood, which I hope most of you have understood, just like I've seen some comments there. Otherwise, see you next time, where now we shall go and review. We shall go and review how to compute the diluted earnings per share. I've said that does not take a lot of time because you have the concept now. We are still going to borrow from the basic. When you are computing diluted, we are going to borrow a lot from the basic. Now that you have understood, we shall now do it very fast. Within 20 minutes or so, we will have reviewed the diluted. Then we do the 2 past paper questions if time will allow. Bye for now. See you next time. Bye for now. See you next time. Thank you for the sacrifice star. Thank you. Fantastic. Thank you. So call me on that number if you need the videos. They are available. Bye. Good night.